Was it raised by mistake or what? Abdullah, was your hand raised by mistake? Okay, fine. Um, Karamo is joining us. Okay, so now let's start. When we talk about investment appraisal, what are we saying? What is investment appraisal? Investment, one word, appraisal. What is investment and what is appraisal? Francis, you want to try? This is a common thing that we say every day. I have an investment there, I have an investment, or I have to do some investment in order to, get ready for a rainy day, and stuff like that. So, and of course, we keep saying appraisal, staff appraisal, this appraisal, and stuff like that. So, what is investment appraisal?
I think investment appraisal is at the end of, let's say, the performance of whatever you have invested at the end of the period. Let's say I did an investment, and at the end of the period, I want to appraise what exactly have I gained from that investment.
Okay, fine. It may be done at the end of the period, but investment appraisal is a proactive tool that is used in advance. Usually, before you invest, you have to know how your investment is going to do, how your investment is going to perform. So you usually do it in advance. But anyway, you could, of course, appraise your investment at the end of the period as well. Okay, that's true. Okay, so any other attempt? What is investment appraisal?
Hello?
Hello, Mr.
Yes,
Suleiman.
Suleiman.
Yes,
Hello.
Let's give chance to
it's just a
Suleiman.
way
Yes.
of assessing whether the business you want to venture in will be profitable, or how would it perform when you go into it. I think.
Okay.
Yeah.
I think that's in summary that is it. You've said it, Mr. Cole. An investment appraisal is assessment of how your business or your project is going to perform in the future. So, in other words, if you put in money in either a business or a project meaning you acquired an asset, you acquired a machinery that you want to use for production. If you invest your money in a project or in an asset or in a business, you want to know how your money is going to bring about revenue, whether your investment, whether the injection of your capital is going to bring profit in the future, or is it going to be losses? Okay? Very, 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 very important. Okay. The difference between investment appraisal and short-term decision making is investment appraisal usually involves various years. Okay, more than one. Okay, so when you inject capital, when you put in money into business or any other venture, you want to know now, how that business is going to perform before, in fact, you start implementation. Okay, so that's really, really important, because without that, you might just go into a business which will only generate losses. And nobody wants to go into a business whereby the end product will only be losses. Okay? So this is what we mean by investment appraisal, in short. Okay, so it's a way that a business will assess the attractiveness or profitability of a possible investment or project that will last over a year, just like I said. So it has to be more than a year. So these are examples. You can buy a plant. A plant is like a fixed machinery, okay, that you can use to manufacture. example, you could buy a machinery to produce toilet soap or to produce donkey soap, and stuff like that, So you want to know, if you buy this machinery, whether it's going to be profitable for the business in the future. Okay, or you can invest in real estate. A company wants to invest in real estate, or you as an individual, you want to invest in real estate. Okay, so there are lots and lots of different types of investment. You want to acquire shares in a company. Shares, in a company, meaning you buy ownership of a company, and in return you can get what? Dividends, isn't it? You can get dividends. So these are all forms of investments. Okay, so many of them. You could in fact invest in education by deciding to go and pursue a degree program at a university. Okay, it's also another form of investment. You will incur some cost, but then you're going to realize some profits, some revenue, and of course profits in the future, such as Paretos. Okay, so now we know what an investment is. Let's look at the decision-making process if we want to invest, either as an individual or as an organization. Okay, these are some of the procedures that will be followed before one can conclude that I want to invest in buying a machinery, I want to invest in poultry farming, I want to invest in agriculture, in tree plant, in fruit plants, and stuff like that. Okay, so they are all forms of investment. So the first thing is there has to be an origination of a proposal. Somebody has to come up with an idea. Okay, if it is an organization setup, it might be staff. Staff say, oh, but I think we should. Maybe let's say GRTs could say, okay, I think we should buy, a machinery that will, enable us to produce, films, and enable us to edit, fast and stuff like that. Okay, so the idea must come from someone, Then two, it might not be one person, of course. The idea or different ideas might come from different people. Okay, somebody will say, okay, let's buy a machine. Somebody could say, okay, let's do some construction and try to maybe hire it for, rent and stuff like that. Okay, so the second process, you screen. Okay, you screen various options. Okay, you have to look at whether the project, that is being proposed, whether it matches with the long-term objectives of the organization as a whole. If we go into it, is it viable financially? Is it viable technically, and stuff like that. So you do an initial screening. Then number 3 will be an extension of number 2. So you do in-depth analysis, screening, to come up with, a conclusion. This will include financial analysis, organization prepared investment. Okay, so this number 3 is what we as accountants will do. We'll have to advise them whether this project will be a worthwhile venture or not. So we do analysis and we make recommendations so that management can, accept the best alternative. Of course, this will include calculating the finances using the various investment appraisal techniques that we're coming to look at in this diet. Okay, and then the 4th point is, naturally, if the project has been implemented, there has to be some monitoring and evaluation and review to ensure that whatever targets we set ourselves are being met or not. Okay, I hope this is clear. So basically, these are some of the procedures we follow before we take investment decision. Is that clear, class?
Yes.
Hello?
Yes, it's clear.
That one? It's clear. Good. It's clear. Right. So, number 4 is what we take care of. And how do we take care of it? Sorry, number 3 is the analysis. So, we do that by using our various techniques as accountants. The first technique we're going to look at is the payback period. The period, days, weeks, months, or years, is going to take in order for the organization to recoup its initial capital outlay. So if you have spent $500,000 on a poultry project, you build your poultry house, you buy your inputs like your feeders, your drinkers, you bring your day-in chicks that you buy. Now you want to know this 500,000 you have injected into this poultry business, how long will it take for you to get that back? Okay? Is it going to be 2 years? Is it going to be within 6 months? Is it going to be after 5 years? No, like that. So that's what we call our payback period. The second one is the accounting rate of return. Okay, so the accounting rate of return is very similar to ROCE, that's return on capital employed. Okay, but this time around it's talking about the project. So if you invest in a project, what will be the rate of return? Okay, so usually you compare this to a target rate of return, and you can either accept or reject. Then we're going to look at the discounted cash flow techniques. Like I said, the discounted payback period, the net present value, and the internal rate of return. The payback period also has got a discounted, version as well. Okay, so it's the same payback period, but this time around, all future inflows and outflows are discounted to today's value. Okay, so we're going to look at the payback period. Okay, we're going to look at the first one, which is the payback period. Okay, so like I said, it is the time required. This is according to CMA's definition. Is the time required for the cash inflows from a capital investment project to equal the initial cash outlay. Okay, how long will it take for you to generate the $500,000 that you spend on your poultry business? How long? Okay, so it's often very, 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 very important as an initial screening method. Okay, you don't depend on it completely, but it's good, as an initial screening method, because if you know that it's going to take less time to get your money back, then that will look attractive. Okay, so that will look attractive. So it's good to screen your project using the payback period method. Okay, but you must not stop there. Okay, so in payback period, we use profits before depreciation, amortization, and all other notional costs is what we call cash flow. Okay, so in payback period calculation, we use profit before depreciation or cash flow. Okay, so let's look at the advantages of payback period. The advantages of payback period, sorry. Yeah. First, it focuses on early payback and it enhances liquidity. Okay, so in payback period, our decision is based on, how quickly we can get our money back. Okay, so that means projects that pays back quickly are more attractive to us than any other project. Why? Because it's going to enhance liquidity. Liquidity means cash coming back to your hand, meaning if you want to do other things, you'll be able to have access to cash to invest or to make payments of liabilities and stuff like that. So it's a good method for quick initial screening, like I said. The short-term forecasts are likely to be more reliable. Okay, the calculation is of course quick and simple. Okay, so the disadvantages, it ignores the timing of cash flows within the payback period. For example, if you have a project that will pay back quickly, you're only concerned with the inflows within the payback period. So usually after the payback period, the other cash flows are not kind of considered. Okay? So it also ignores the cash flows after the end of the payback period. It ignores time value of money. This means that it does not take account of the fact that $1 today is worth more than, okay? The non-discounted payback period does not take time value of money into consideration. Okay, so if an amount is supposed to be earned in 2 years' time, it just takes the amount as it is. But we know as accountants that $1,000 today is not the same as $1,000 even in a month's time. If you have a $1,000 today, what is going to get you, you may not be able to get that in the future. A typical example is a bag of rice. 2 years ago, when you have, let's say, 1,100 or 1,200, you can easily buy a bag of rice. But today, you can buy a bag of rice for far more than that. Is that not the case? Is that not the case, class?
Yeah, it is.
Yes. So time value of money is very, 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 very important. Okay. Especially in countries that have got hyperinflation. Okay. We haven't got hyperinflation in the Gambia, but inflation here is very, very, very high. Okay. Right. So having understood the concept of payback, let's just look at this question. Let's discuss this question. The first one and then the second one that says payback, we can just do that. They are all very, very easy questions. Okay, I think the methods that are a bit complicated in investment appraisal is the DCF techniques, the discounted cash flow techniques. Okay, so it says, look at the figure below for mutually exclusive projects. This means that only one of them can be undertaken. Project P, Project Q. The cost of capital, the cost of asset is 60,000 for each of them. The profits before depreciation, okay? And what are profits before depreciation? What are they called? What are they called? Profits before depreciation. We just talked about them, didn't we? Don't mind me, I've not had my lunch, so. Hello, are you with me? Hello?
Yes, we are with you, sir.
Yeah.
Yeah, when we talk about profit before depreciation, what are we talking about?
about cash flow, no, sir?
Yeah, correct. It's cash flow. Profit before depreciation means profit that excludes notional costs. Okay, we know cash flow is real. Cash is different from profit. We all know that, yeah, as accountants. That's why we are required to prepare our cash flow statement in addition to our income statement and our statement of comprehensive income and our statement of financial position. Okay, our P&L and balance sheet. In addition to them, we are supposed to prepare cash flow statement. Why cash flow? Cash is different from profit. Okay, to arrive at an accountant's profit, you go through loads of things that are non-cash in nature. Depreciation is among them. Depreciation is not realistic, and people can calculate them differently. Okay, some can use straight line, some can use reducing balance, some can use weighted average methods. Okay, and even if you use the same straight line, for example, some organizations depreciate their motor vehicles differently to some other organizations. For example, some organizations could say the useful life of their motor vehicles is 4 years, while another organization could say the useful life is 6 years, and so on and so forth. Okay, so those non-notional costs like depreciation, amortization, provisions, and so on and so forth, they are not considered when we are doing our cash flow. So that's why cash flow is more realistic, is more reliable, because if it is there, it's there. Okay? An organization could make huge profit when it does not have any money in its bank account. Do you know that? Do you know that?
Yes, it's possible.
You could have huge profit, but then there is no money in your account. Okay? Very possible. Okay? So profit does not equal to cash. Right. So we're going to continue. Profits before depreciation are this. That means cash flows year 1, year 2, up to year 5 for project P and for project Q. Project P pays back in year 3, 1/4 way through year 3. Project Q pays like half through. Okay, so let's look at both of them without doing any calculation. In project P, what was the cash injection? What was the initial outlay? What was the initial outlay? In other words, what was the cost of the project? How did you? Okay, Karamo, yeah, Karamo, go ahead.
Yeah, the cost of the outlay is $60,000. Wait, pounds, right?
£60,000. Okay, £60,000 is the cost of the project. Good. So this £60,000 in year 1 we are going to get back 20,000. In year 2 we are going to get back 30,000, and in year 4 we're going to get what? 40,000, and so on and so forth. But look at project Q. Project Q, the initial outlay is 60,000. We are getting 50,000 in year 1, and in year 2 we are going to get 20,000, and thereafter 5,000, 5,000, 5,000. But out of these two projects, which one is going to pay quick? Which of the projects is going to pay back quick?
Product Q, I mean, obviously.
Project Q, yeah?
Yeah.
Excellent. Project Q is going to pay back quickly. Okay. The reason is when you look at Project Q, you invest 60,000, and just the first year, at the end of the first year, you are going to get back 50,000. So that means, when is Project Q going to pay back? Project Q, when is it going to pay back? In which year?
Year 2.
Year 2. Excellent. Year 2. So it's going to be 50,000, and less 50,000 from 60,000 is 10,000. So that means you require 10,000 from 20,000 in year 2. So that means it's going to pay back in 1 year, 6 months. Is that not the case? 1 year, 6 months.
Yes.
Good. So, but what about Project P? Project P, there was an injection of 60,000. In year 1, they're going to realize 20,000. Year 2, 30,000. Okay. Cumulatively, how much will that be? 50, isn't it?
50, yes.
Yes. So now, Project P, in which year is it going to pay back?
Year 3.
It's going to pay back in year 3. So what is the payback period?
Yeah.
The payback
It's
period
2
will
years,
be
3 months.
2 years, 2 years, 3 months.
3 months,
Okay.
3 months.
Because it's going to be 20 plus 30, that's 50 minus 60 is 10. 10 over 40, that's 1/4. So a quarter of a year is 3 months. So correct? 2 years, 3 months. Okay, 2 years, 3 months. Correct. So this is the way we arrive at this. So now let's just do one more question on payback period, and we move on to accounting rate of return. Okay. So can you make sure you screenshot this before we go to our Excel? So I'm going to go to my spreadsheet and open it. New spreadsheet. Okay. So I'm going to stop presenting. And I will. Okay, so this is the worksheet, new file I open, and I'll call it investment appraisal. Investment appraisal section solutions. Let's call it investment appraisal solutions. That's it. Investment appraisal solutions. Okay. So the first question that we have is example on payback period. An asset costing 120,000 is to be depreciated over 10 years to a nil residual value. Profits after depreciation for the first 5 years are as follows. So these are all profits after depreciation required. Calculate the payback period to the nearest month. Okay, so these profits that have been given, they are profits after depreciation. And what is profit after depreciation? What is profit after depreciation? You all agree that profit before depreciation is the same as cash flow. What about profit after depreciation?
Discounted cash flow, maybe?
Discounted cash flow? No. It's simple. It's also profit, but it's called what? An accountant's profit. Okay? An accountant's profit. That's the profit you get after going through your accounting standards, after preparing your financial statements according to your accounting standards. So is what? Is the accountant's profit. Whilst profit before considering depreciation, amortization, provisions, and all other notional costs is our cash flow. Period. Okay, is that clear?
Sir.
Good, good, good. So, right, now, how are we going to tackle this question? We've been given accountant's profit, but do we need accountant's profit to calculate our payback period? Do we need accountant's profit to calculate our payback period? Payback period is calculated on what? Is it calculated on cash flow or is calculated on accountant's profit? Can you answer me, class? Hello? I have said this many, many times in this class.
Cash flow.
It's calculated on cash flow. Correct. Now, do we have cash flow in this question? Do we have cash flow?
No.
What we have, the 12,000, 17, 28, 37,000, and 8,000, is it cash flow? Or accountant's profit? Your response is very slow. We need to go
This
fast.
is accountant's profit.
The profits after depreciation.
Is it cash flow or accountant's profit?
Accountant's profit.
It is accountant's profit. And you don't need accountant's profit to calculate payback period. Okay? Accountant's profit is only used in only one technique. That's the one we're coming to do next. That's the ARR, the accounting rate of return. All other methods use cash flow. Okay? Please take note of this. In all the investment appraisal techniques, all the techniques uses cash flow except the accounting rate of return method, which uses the accountant's profit. Is that correct?
Yes.
Okay, so in this case, if we have the accountant's profit and we want to calculate cash flow, what do? This is very, very important. Take note of this. In this question, we all agreed that we have the accountant's profit, but what we need is cash flow. So what do we do to get cash flow? What do we do to get cash flow? Hadi Gay, are you with us? Hadi? Are you still at work? Hadi? Hadi Job?
Yes, Mr. Fofana.
Yes, Hadi. Yes. Hadi, yes. Can you tell us what should we do?
Mr. Fofana, to be honest, I was not. I am just joining the class. I'm having my lunch. I'm just from work.
And you have two appliances on at the same time. Maybe switch one of them. Oh.
Okay.
I have not got my lunch and you are taking your lunch. Is that fair, Hadi? Okay, Mohammed So.
Yes, sir.
Yes, so what do we do? What do we do to get cash flow?
Well, yeah, since we need to know the amount of cash that comes, or the inflow of the cash, and then here we are already given the accountant's profit. So I think what we need to do is we depreciate the asset. That is the asset that is costing 120,000, and then they say the duration is 10 years.
Yes, we depreciate the asset. Good step.
by 10 years, that amount we add it back to the accountant's profit is going to be our cash flow.
Good, very good, very good. So if you have an accountant's profit, always an accountant's profit is always net of depreciation. You cannot have your accounting profit without deducting depreciation from it, unless you use a cash method of accounting. But accruals method of accounting, you will have to deduct your depreciation from there. So if you deduct your depreciation from there, for your information, amortization and depreciation is almost the same. Your provisions and all other non-notional costs, if you remove them from there, you will have your accountant's profit. If you want cash flow, because you have removed them, you need to what? Add them back. Okay? This is not only depreciation, but if you have amortization, if you have provisions, provisions are all non-cash in nature, like provision for bad debts, provision for doubtful debts and stuff like that. So all those needs to be added back. So this is why we are adding back whatever we have deducted, okay, whatever we have deducted, so that we can get our cash flow. Okay, is that the case? All right. So let's go and do this. I just say payback. Okay, so we agreed that we have to calculate our depreciation and add it back to all our profits after depreciation, all our accountant's profit, so that we can get our cash flow, and we use that for our payback period determination. So let's put them in a columnar form. So the first one will be year. The second one will be profit after depreciation. Accountant's profit, isn't it? Profit after depreciation. And we're going to do our depreciation so that we can calculate it easily. Then we'll have our cash flow. To get our cash flow, we agreed that we have to add the two. Okay? We add the profit after depreciation. We add it to the depreciation to get our cash flow. Okay, and we can do a column. It's not mandatory, but if you want, you can include a cumulative cash flow. Are you following, class? Are you following?
Yes, sir.
Okay, good. So we will have year, we will start with year 1 and then 2, 3, like that. So I'll start year 1. Okay, so what do I do to do year 2 and 3 and so on and so forth? Let's do some spreadsheet functions. Let's what are we going to do? I have year 1. I want to do 2, 3, 4, 5, like that.
You drag it from. You can drag from year 1. Just
I can drag from. So I click on here. I drag. Yeah.
No. Yeah. Go to the. Yeah. That. Yeah. Exactly. Drag.
Drag. Okay. I have dragged.
Sorry, sir.
No.
No, sir. You have to click on the where the inverted commas is first. Then you type your number. Then you can click and drag.
Sorry, I should do what?
I said you have to click on where the inverted comma is. You click on that that key from your keyboard. Then you type the number and you drag.
Inverted comma.
Yes.
Inverted
Click on it.
comma.
Then you type the number. Yes.
I click on that, then I drag the number. If I click on, I don't see anything.
No, you type the, no. When you click on, it, you have to type number 1.
Okay, good. I've seen your idea.
Then click. Then
yeah, yes.
What drag?
No, let's put it this way, Karamo. You say type single inverted comma. Okay, so you type single inverted comma and then 1. You enter. Good. And then now if I drag, it's going to work. Excellent. That's good.
Yeah.
That's good, Karamo. That's good. But there's another way of doing it, which is also fast.
Let me help.
Yes? Usman, yes, go ahead.
Okay.
I'll tell you various methods. What Karamo said is correct. It's very, very correct. But the only problem with that is like assuming you want to add the numbers. Okay, assuming you want to add the numbers, this is not shown as a number but a text.
Yes. So you put 1, 2.
Okay, good. Usman is also telling me another way. Okay, I type 1.
Another 1, 2.
Another 2.
I like both of them.
I like both of them.
And then drag from that corner there.
Good. That's a good one also. Thank you, Usman. Thank you. There is another one which is more complicated.
Yes, there's
there is another one which is more complicated. I'll tell you about it, but don't worry if you don't know about it. That will help you.
I have another one also.
You have another one. Okay, yeah, go ahead.
Okay, just type 1. Okay, go to this other cell, next one. Okay, just click plus.
Okay, I say equals.
Okay, then click 1. That the one first. Yes. Then plus 1 again.
Plus 1. Okay.
Press enter. Now drag from there. Drag.
Yes, that will also do. Good. That's a good one as well. Yes, that's another method by adding it. Okay. So let me show you the final method, which is how to call it. The advantage with this one is in future, if you type anything, okay, if you type anything on column C, it's going to bring the number in for you automatically. Okay, it's going to give you the number in automatically. So let's see how that's going to work. It's a long formula, bear me out. So you say equals, we'll put if error. Okay, if error, then bracket opens, we'll do sequence. Okay, we'll do count A. Okay, so we're going to start counting from where? From C6. So you type C6. Okay, bracket closes. Then you say comma. What you do if it's an error, then bracket closes again, bracket closes, enter. So it's displaying an error. So let me just do that again. So we say equals if error in sequence. Okay, count A. Sorry, COUNT-A. Okay, count A from C6, isn't it? C6 all the way to C. Okay, bracket closes. Bracket closes again. Yes, I missed that bracket close. Then we say comma. What do you do if there is a sequence? Bracket closes, enter. Okay, so this is the formula. See, what happens is if you click in here, you don't see anything. Okay, but at least the formula is there. It's not going to work if you don't type anything here. So let's try to type something. Let's say we type 1, look at it, it's going to give us a number. Let's say we type that, it's going to give us numbering. Let's say we type this, it's going to give us numbering, just like that. If you type anything, it gives you an auto numbering up to anywhere within the cell. Can you see this? Just one formula. So this gives you auto numbering. Can you see? Are you with me?
Yes.
Yes.
Yes, sir, yeah.
Okay, so is this function is called the sequence count A. Okay, the if error is there so that if the cell is empty, it won't bring hashtag error. It won't bring any error message. Okay, so now we are not, so after typing this, you don't do anything because it's going to give you the auto numbering. So the first thing we're going to do is let's calculate our depreciation. Okay, let's calculate our depreciation. How are we going to calculate our depreciation? I'll make this
Just
green.
120,000 divided by 10.
Huh?
We just divide the asset by the duration.
The asset. What asset?
The question says an asset
cost of the
120,000.
cost of the asset and divided by the life is the livelihood.
Exactly, the cost of the asset, not the asset. The asset is different from its cost. Okay, so the cost of the asset is what? 120,000 divided by its useful life. But is that the formula for depreciation? Straight line method depreciation, is that the way you calculate it? Is that the way you calculate it?
Yeah, for straight line, yes.
No.
You take the value of the asset and divide by the number of years. Is that the case?
No. That's not the case.
What is the case?
Case is the asset minus salvage value.
Please don't
That is
use
reducing
salvage.
balance method.
Don't use salvage value. We are colonized by the British. Let's
the
use
scrap
the
value. Scrap value.
The scrap value, exactly. The scrap value.
Yes.
Okay, the scrap value. Let us not get too mixed with the American system, yeah? So we're going to calculate the depreciation as the value of the asset, which is 120,000, minus the scrap value. Even though the scrap value is 0, you still need to put it into consideration. Okay, all that in brackets. Divided by the useful life of the asset. And what's the useful life of the asset?
10 years.
10 years, yeah? Okay. So that means the depreciation for the asset is 12 years. So let me format this by using the financial, but then I will reduce the decimal place to 0. Okay, is this clear? So now for all the 5 years is going to be this. So we just duplicate. So once we duplicate, look at it. All the numberings are done for us. Can you see? Once you duplicate, the numberings are done for us automatically, like a magic.
Mr.
Can you
Fumana?
see? Yes.
But now, where we wrote that, the heading there is profit after depreciation. Is that where it should be, or is in the other column, the second one, D, under D?
Oh yeah, sorry. You're right. So this should come, you're right. Thanks for that observation. So this should definitely come to depreciation, paste. Okay, so the profit after depreciation is the one we have in our in our question, isn't it? So that will be 12,000. Correct. Thank you for that. So that will be 12,000. Give me the figures. 12.
17, 28, 37.
17.
28,000.
28,000.
37,000.
37,000.
And 8,000.
Look at the way the numbers are appearing as I type. And the last one is 8,000. Okay? 5 years. Correct. Thanks for that correction. So it's 12, 17, 28, 37. 12, 17, 28, 37. Okay. So what's the cash flow? We add the two, isn't it? We say equals this plus that. Okay. So we just keep that. And cumulative cash flow, what formula do we put for the cumulative cash flow? Can someone give me the formula to calculate the cumulative cash flow?
Yes, it's going to be E6 plus E7.
E6
plus E7.
Plus E7. E6 plus E7.
Sorry. Sorry. The first one should be no. The first one should be E6.
The first one should be equals E6.
E6. Yes. So yeah, it's only E6. The first one, cumulative.
Yeah, but we want to replicate it. We want to do one formula and replicate. Because otherwise, if you go to the next cell, you have to do another formula. E6 plus F5, the one before. Okay, then now if you replicate this, it gives you everything. Is that correct?
Yes, clear.
Correct. So
Governor, can you do that again?
Yes, I'll do it again. You know, to find the cumulative of a number, it will always be the how to call it, the cash flow for the current year plus the previous balance, isn't it? So that means for the first year, it's going to be this plus whatever is in here. There's nothing here, but even that you have to, if you come here, it's going to be what? This plus down. Okay, so once you do it on one, you replicate it, everything will flow just like that. Is it understood?
Yes, it is.
Okay, excellent. Excellent. Okay, so let's proceed. Now, this is our cumulative cash flow. I'm going to make it bold because we're going to use it for the decision. Our initial outlay is how much? Our initial outlay is how much? What is our initial outlay? The cost of the project.
120.
120.
120.
Yes. So we are trying to find out which years and which months are we going to be able to recover this 120,000. Okay. So now tell me, without calculating the month, tell me it's going to be between which years now? It will naturally have to be
between 3 years, 7 months.
Between
3 years, 7 months.
No, don't tell me the months yet, but tell me between which years.
Yeah, 3 years. Yeah.
Going to be between
Around the 4th year.
No, so it's going to be between 3 and 4 years. So it's going to happen in the 4th year somewhere. We agree that. So first, initially, we know that without doing any calculation, we know that our payback period will be 3 years plus. So we at least know that the payback period will be 3 years. Now is the number of months that we need to calculate. Okay, so how do we calculate the number of months? 3 years is simple because up to year 3 is 93,000. But when you go to year 4, it's 142. 142 is more than 120. So that means it's going to be 3 years plus some months. So that means the payback period is going to fall within year 4. So we know it's 3 years. Now we have to calculate how many months. How do we calculate the number of months?
Yeah,
The 49.
Yes.
Okay.
Yeah, so yes, you can say yes. Like between that, you can say like for example, we know the outlet is maybe 120,000 now. We can subtract it with where we store where the 3 years. I mean the cumulative cash flow of the 3 years, which is 93. Then we over it by the flow of the order of where the months fall. That is 49. The cash flow of 49,000.
Sorry, let me just get that right. I'm just trying to display some of the formulas that you have learned so that for your future reference, you could easily look at them. Okay, so this is one of them that we have learned. Okay, say that again. Say that again, please.
Yeah, what I was saying is we are going to the outlay we know is 120,000. So we are going to subtract that by the at year 3. The cumulative cash flow at year 3 is 93,000, right? Yeah. So we subtract, then we over it by the cash flow of where the month it falls. We know it's 3 years, some month. So the month where it
So
falls,
we're going to say equals 120,000 minus 93,000.
Yeah, and we over
Okay.
it by the cash flow for the month for yeah. You know, open
And
the
we
bracket
divide
before,
it by? We divide
we
it
divide it
by?
by 49,000. That is the corresponding cash flow of the month.
We divide it by the 49,000. Why not the 142,000?
No, we don't. We don't need the cumulative cash flow because like it's like, how do I put this?
How do you put what?
I mean, how do I put it into words? It's in the head, but I don't know how to put it in words.
You are correct. Actually, you're correct. But I want you to have a better understanding of it. So you're saying we should divide it by what? 49,000. I'm asking, why not 142,000?
Yes, because because the 142,000 is a cumulative
Because
cash flow.
142,000.
It's cumulative. It included both what was the year before, there's the 93,000 and then the 49.
Okay. So the 142,000 is the cumulative. It's not just the year before. It's the cumulative up to year 4. Okay. So to make it clearer, you know, up to year 3, you have recouped, you have made cash sales of 93,000, but you need 120,000. So now this 93,000, you less it from what you need. Okay. Whatever you require out of the cash flow of the year you want it from. For example, you require the difference between 120,000 and 93 from which year? From year 4. And the cash flow for year 4 is 49,000. And then you express that into months. Okay? So 120,000 minus 90,000 divided by what?
49.
Divided by 49,000, isn't it? Okay? 49,000. Correct? Is that all? So we'll have 1.
You have to multiply by 12.
Okay, so all that multiply by, you need to obey your board mass. All that multiplied by 12. So that gives you 7. Okay, so we want this number to say 7 months. So we're going to do custom number formatting. So I'm going to show you how to do custom number formatting. Okay? So you're going to learn custom number formatting so that this number here, 7, instead of just saying 7, is going to say 7 months. We have 3 years. We want this to say 7 months. But if you want to type months here, is it going to work? If I type months here in this cell here, is it going to work?
No.
Huh? It's not going to work. Why? Because we are mixing text with numbers. Excel does not allow that. But then if you do custom number formatting, you could mix numbers with text and it will still accept it. So to do custom number formatting, we click on where we want to custom number format. We go to the format menu. We go to number. We go and select more formats and then custom number format. Now, we want to do custom number format so that we can have our number suffixed with what? With months. So you have to choose the number format that you want. Do you want your number to be in 2 decimal place or 0 decimal place? Do you want it with 1,000 separate and so on? But we want it with no decimal place, so we choose this. After choosing this, now we have to state where we want the text to be. So we want the text to be immediately after the number, but leaving one space. So you click inside there while the cursor is popping up. You type double inverted comma open. Then you hit the space bar once, and then you type what you want to type, which in our own case here will be months. Then you do double inverted comma close. Okay, and it has given you the sample 1, 2, 3, 4, 5 months. Then you say apply. So once you say apply, look at it, 7 months, nicely done for you. Okay, so this is what we call custom number formatting. Is that clear, everybody?
Mr. Governor,
Yes.
I observed something.
What have you observed?
I don't know if it matters or not. This 7 months, it's not actually up to 7 months. It's 6 months some days. So I don't know if that matters or not. But because you remove the decimal places, that's why it brought 7 months.
It's here. I've taken it back.
Okay, very good.
It's 6.61 months. It doesn't matter. You can round it up to 7 months.
Okay, very good. That's what I want to know.
If you leave it like this or you round it up to 7 months, it's still the same. Okay. But do you know how to do custom number formatting?
Yeah, I think I can do it.
You think you can do it? Okay. Right. So this is the way we do our payback period. So we know that this particular project is going to pay back within 3 years, 7 months. Okay. So we're going to move on. Any questions, please? This is very, very easy and straightforward. Pretty easy and straightforward. Any questions?